Why is active management compelling for fixed income investing? I'm Jim Rowley. In this video, we'll explore the effect of factors in active fixed income, how index and active strategies can work together, how costs have impacted excess returns in active bond funds, and the challenges today's uncertain market environment can pose for clients who invest in active fixed income. An active manager can use systematic risk factors and bond-specific credit risk analysis to differentiate themselves versus benchmarks and peers. When we think about systematic risk factors such as term, credit, and even prepayment, those are all sources of expected excess returns. Now, active managers can differentiate themselves relative to peers and benchmarks by using these risk factors strategically and tactically. Strategically might mean an enduring use of the factor, something that might be more permanent. And tactical might be akin to market timing or something that is of the moment. And then finally, on top of these systematic risk factors, an active manager can attempt to use issuer-specific credit research as sort of an alpha topper on top of their use of systematic risk factors. I actually like to think about the concept characteristics, not labels, when combining funds in a portfolio. If we think about systematic risk factors such as term and credit, they are major drivers of bond performance, regardless of a fund's label as active or index. And how a fund uses these risk factors helps describe the fund's characteristics. Now, I think the first thing investors should consider when combining funds is, if I put any combination of funds together, what are the resulting characteristics in aggregate? The labels active or index might speak to the reason a fund uses these factors the way they do. Index funds might try to match a particular benchmark index, and maybe we think about that as a way of providing precision. Active funds try to differentiate versus the benchmark, and that might be akin to providing flexibility. Costs have a very noticeable impact on excess returns. This chart supports the well-documented research that there is an inverse relationship between expense ratio and excess returns. Active bond funds have been grouped into quintiles by expense ratio, and when we look across the chart from left to right, expense ratios move from relatively lower expense ratios to relatively higher. The blue dots on the chart represent the average excess return for funds in each of those quintiles. Now, as can be seen, average excess return falls as expense ratio becomes relatively higher. Within each quintile, obviously, some funds do better than the average and some do worse. However, expense ratio is a variable that is quantifiable and known in advance. Funds that possess relatively lower expense ratios give themselves a better chance of outperformance because they curtail the headwind posed by expense ratio. I think the challenge might very well be the need for patience when using active funds. Active bond funds with solid long-term records still experience intermittent periods of underperformance, and market volatility can sometimes be the cause of that. Now, Vanguard research in the past has highlighted this concept of the bumpy road. This is the idea that for funds with successful 10-year track records, it's common that these funds might experience 2, 3, maybe even 4 calendar years of underperformance during that period. It's a bumpy road. Investors who stayed disciplined during these stretches and demonstrated patience by sticking with these active funds ultimately realized the benefit of those funds' success. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.